Hi, welcome to my channel. I'm Gil Rossi, investor and funds manager. Today I want to share with you my update of the valuation and analysis of ServiceNow. ServiceNow just reported fourth quarter and fiscal year 2022 results, and since I uploaded my previous video, which was in July 2021, there has been some information that I want to incorporate into my analysis and see if that has any impact on the fair value of the company. In terms of the qualitative portion of the company, which is one of the portions I see when I analyze a company, everything that I have mentioned about the quality of the company in that video still stands today. And the only thing I'm going to talk about today is the recent performance and how that impacts the projections and the fair value. So let's go to the recent performance of the company. I'm going to start with the fourth quarter earnings call, where Bill McDermott talks about the company in his remarks, and this is what he has to say.
Thank you very much, Darren, and a warm welcome to everybody joining us on today's call. ServiceNow has once again delivered results that significantly beat the high end of expectations. Here's the Q4 rundown in constant currency. Subscription revenue growth was 30%. CRPO growth was 32%. Free cash flow growth was 32%. Adjusted subscription billings growth was an exceptional 33%. Operating margin was 23%, 1 point over our guidance. We had a record 135 deals over $1 million, which was up 50% year over year.
Let me stop him here, and I'm going to show you also the fiscal year highlights for 2021, and you can see that all the measures that he mentioned are incredibly strong for the fiscal year 2021 as well. So now let's go back to Bill McDermott's remarks.
There has long been a rule of 40 benchmark for highly successful software companies. These results demonstrate that ServiceNow operates beyond the rule of 60. The company is expanding in all geographies, industries, and buyer personas. Gina will share the details in a few moments, including our strong 2022 guidance. ServiceNow is uniquely positioned. We're growing like a fast-moving startup with the profitability of a global market leader. We're on a clear growth trajectory to 15 billion plus by 2026. While our strong cash position preserves optionality, we don't depend on M&A for growth. While rising interest rates challenge others, ServiceNow's business model is built to flourish in any economic environment. We are not opportunity constrained, as our customers' need for digital transformation is ever expanding. Our organic growth machine is in full flight, and our pipeline is stronger than ever. Our 99% renewal rate is one of several lead indicators for sustained performance moving forward.
Okay, so that's Bill McDermott's initial remarks on the earnings call. I showed it because there's a few issues that he touches that I want to discuss. First of all, he talks about the rule of 40. If we go to the fiscal year 2021 highlights that I showed a minute ago, the rule of 40 is calculated by adding the subscription revenues growth, which is 28%, plus the non-GAAP free cash flow margin, which is 32%. So if you add these two, it's 60. And this is a metric that tries to measure the strength in growth here and the strength in profitability of a company. Normally, this rule of 40 can be computed in different ways. The growth of a revenue could be GAAP revenue or non-GAAP subscription revenue or non-GAAP subscription billings in the case of ServiceNow, and the profitability margin could be operating cash flow, non-GAAP free cash flow, EBITDA without stock-based compensation, non-GAAP operating income, GAAP operating income. So different ways of measuring this. What they are measuring is either this 30% plus this 32, or probably this 28%, as I said, plus this 32. But both of them are strong. And as he mentions, ServiceNow is growing as a startup, but with the profitability of a market leader, of a mature market leader. So I think that these are intriguing qualities of ServiceNow, which are not easy to find. And because you see the company uses non-GAAP quite substantially, let me talk about that reconciliation for a minute. What they do when they reconciliate, in this case, for example, we are talking about the income from operations. What they do is they take the GAAP income and they add stock-based compensation, amortization of purchased intangibles, and business combinations and other related costs. And this is for 2021 the numbers. The income, GAAP income, is 257. If you add these three, the most substantial adjustment is here in the stock-based compensation. You see 1.1 billion, which brings the GAAP income from 257 to 1.5 billion almost. It's a tremendous difference, really. And the non-GAAP operating income becomes 25% from 4%, which would be the GAAP operating income. So a huge difference here. I normally do not like to use stock-based compensation as an adjustment in the income statement, because even though it is a non-cash charge, it is a charge in any case. But this is the way that ServiceNow computes it, and this is how they calculate the rule of 40. He also talks about the expansion of customer relationships, and you see here they list from the fourth quarter of 2019 the number of customers with average contract value of over $1 million. And you see how this number grows quarter after quarter after quarter after quarter. And recently it grew 135, as he mentioned, even though here the difference is 99, because of course this is a net growth. The other interesting thing is that the average of all these contracts is also growing. And if we show this same graph, but going a little bit further in time, you see that in December 2017 it was 505, the number of customers over 1 million, and the growth is quite steady. You know, it's I don't see any impact here around the pandemic, when the pandemic hit. I don't see it here in the number of customers, and I don't see it here in the average. You see, it's as if this company has been growing and kept growing through the pandemic in exactly the same way that they were growing before. And if we multiply these two, let me show you what happens with revenue. This is again the average I showed you a minute ago. And if I multiply the average by the number of contracts on any given quarter, I have the proportion of revenue that comes from those large customers. And you can see that it is growing quite fast. And what's important here, I think, is that when you have customers of large contracts over 1 million, that means that they have more than one product. And when you have more than one product with one company, the chances that you're going to change from one company to the other are much slimmer. So this shows a strong competitive advantage coming from the switching costs of customers. And they mentioned in the fourth quarter of 2021 that 18 out of the 20 largest deals hired 5 or more products from the company. So this is a great sign that goes hand in hand with this growth, and also with the competitive advantages that the company has. Now let me show you another graph that I like, that they normally show, and it's the customer cohort growth. I talked about this graph in my previous video in detail, but let's review this here quickly. What happens is that those customers that started with the company in 2010, if we assume that they had 100 million contract value, these same customers, when we go to the fourth quarter of 2021 here, they have 1.7 billion in average contract value. So this means that the annual growth is 17 minus 100 is this 1.6 is what these customers have added during this period. And if we divide that by the 11 years that we have here is 149, which is 149% the starting value. So this is how each of these numbers is calculated. And there's a few interesting things I see here. One of them is that, as you can see, they keep growing from the youngest cohort to the oldest cohort. So this graph also talks, or is a different way of showing that expansion of customer relationship that we showed a minute ago. And if we now check the same graph, but the one I showed in the previous video, let me compare the two. And this is an interesting thing. Look, from the first quarter to this fourth quarter, all the numbers here are higher. 54, 56, 74, 78, etc., etc., 134, 149. So what this means is that every single year, every cohort is adding more and more and more products to the contracts that they have with ServiceNow. So this to me shows customers that are really happy with the service that ServiceNow is providing. And the same can be seen here in the renewal rate, something that McDermott talked about. And look at the renewal rate, 99%, it goes down to 97, 99, 97, 98, 97. It's between 97 and 99 since December 2015. And it's been 99% now in the last quarter. This also talks about customers very happy with the service that the company is providing. And also talks about the competitive advantage that I just mentioned about the switching costs. Let me show you another interesting thing I see. The total quarterly revenues, if we plot them in a graph, we have from March 2017 to until today, and all this is pre-pandemic, so before December 2019. And you see it grew at 35% compounding annual growth rate pre-pandemic. Post-pandemic, it grew at 30%. And if you see, I don't see any spike or any acceleration. So that was something interesting that I noticed. And even though this company is benefiting from the digitalization of the economy, and of course the digitalization of the economy was accelerated in the pandemic, I don't see that in the revenues. I see that this company was growing quite strongly even before the pandemic, and it kept growing after the pandemic or within or during the pandemic. So to me, this is a sign that this growth will continue at least in the near term, as strong as we can see it here. So let's now go to the projections, and I'm going to start with revenues. And here we have revenues for the past 10 years, and here below the assumptions that I'm making for the next 10 years. So let me show you this number here. December 2021, the revenue was 5896. My assumptions for that, when I did the projections before, I'm going to show it here as of July 2021, my assumption was 5878. So it was quite similar. So there won't be much change here. But if you see this number, 7274, which is subscriptions revenue as of December 22nd in my previous analysis, and that was coming from a 31% growth that I was assuming for subscription, going down to 18. But the guidance that the company gave here was 7 billion. So I am changing this to 7 billion, and of course this is going to change the subscription revenue growth to 26, and it's going to go to 18. This number I haven't changed, So this is the only change I'm going to make in the revenues, in the projections. That new assumption is coming from this guidance that they provide, subscription revenue to be 7 billion roughly in fiscal year 2022. And you see here 200 basis points of headwind due to currency impact. Of course, if I am assuming 7 billion and I'm projecting from here, starting on 26%, I'm going to assume this 200 basis points headwind every single year, which could be a bit conservative, but I'm going to keep it that way. So this is my revenues. Again, let me show you a couple of numbers here that I want to highlight. December 2024, subscription revenue 10.8 billion. And if we see from the analyst day of 2021 back in April, they are expecting 10 plus billion for that year, 2024. So my assumptions are in line. And also this other number, 16.2 billion, in the same analyst day, they are targeting 15 plus billion, and also something that Mr. McDermott mentioned in the remarks I showed you at the beginning. So I think 15 plus 16, I think I am happy with this. Especially because the total addressable market, also in that same analyst day, they were showing to be 175 billion by 2024. It is growing quite fast, the total addressable market. So out of this total addressable market, 10 billion is going to be the revenue for ServiceNow in my projections, and I think it's completely reasonable. Let me quickly show you the revenues in graphical form. This is what I'm assuming now, and this is what I was assuming before. Of course, this is up to December 30, and now it's up to December 2031. The difference here of these two, you can see, is 5.4% increase. So remember that I am asking for a 10% of IRR for the companies normally when I compute the fair value. So if the company is growing revenues at the 5.4%, that means that these other things equal, this is going to be negative to the fair value. Now let me show you the operating income. I have not changed anything in the operating income. I mean, in terms of the operating expenses versus revenue, but because the revenues are changing, there's going to be some change on these numbers. And the EBITDA at the end of the year 2031 is going to be 9 billion approximately. My previous assumption was 8.8 billion. And let me show that in graphical form again. And this is a 3.6 increase. So that means that the portion of the fair value that I compute based on the EBITDA is going to be smaller this time than last update, because this is only a 3.6 increase, and I am requiring a return on investment of 10%, an IRR of 10%. So my new assumptions, even though they are larger, they are going to be negative to the computation of fair value. Now let's go to the free cash flow. This is the new free cash flow I am assuming down here, and this is what has happened. And I'm not changing anything here in growth or in the capital expenditures to revenue. But one thing I want to notice, and is that because capital expenditures to revenue, of course, depends on the assumptions of revenue I'm making, and the assumptions of revenue you saw they're smaller than before. The growth is a little bit smaller. So that's going to have a positive income on the free cash flow due to the fact that these numbers are going to be a bit smaller, the capital expenditures. So all in all, what I'm going to have is a free cash flow of 11 billion in December 2031. And if I show you the previous one, it was 8.6 billion. So again, if we show the free cash flow in graphical form, we see that the difference is a 28% increase. So this one is going to be positive to fair value. Okay, so now let's go to the fair value calculation and the IRR. So as you may know, what I do here is I take the EBITDA, the numbers I showed you for December 2031, with this ratio that I explained in the previous video, and I'm not going to change. So go and check that video for an explanation of how I come with these ratios. I compute the enterprise value, multiplying these two. I subtract the debt, come with market cap, with the weighted average stocks outstanding, I come with the 2031 price. And I average these two, and it's giving me 1.667. If I show you the previous one, the one in the previous video, it was 1.447. So of course this is a 1 year difference, and if you see, that is 15% from 2030 to 2031. So if the average price is 15% higher and I am requiring 10% of a return, that means that the fair value is going to be higher this time around. So this is what we will have. If we take the price today and have the free cash flow per share adjusted that we're going to, or the company is going to receive up to 2031, and this is the price I'm going to sell the company, this is going to be my free cash flow as an investor. And with that free cash flow as an investor has this IRR. So if I buy at 561, I'm going to get a 13.51% of IRR. But because I am happy with investing at 10%, this is the fair value of the company updated, 152. If we see the previous one, as of July 2021, the one I showed in the previous video, my assumption of fair value was 670. That's my fair value and IRR update. As you can see, ServiceNow is a company that is firing in all cylinders, as they say. I think it's going to keep firing for the next few years at least. I don't see any sign of the company stopping this growth. It has a really very, very nice metrics, a very good margin of safety, I think. If it's trading at 561 and you have a fair value of 752, that's $200 roughly. So almost 40% of margin. So that's all. I hope that you find this video interesting and instructive. If you do, please give it a thumbs up. And I'll see you soon for another evaluation video, probably next week. Bye bye, and thanks for watching.